If you live in Canada, you know the average Canadian family spends about 42% of their income just on taxes. That's more than housing, food, and clothing combined. If you're struggling even after getting a raise, well, this is why. Canada does not have an income problem. Canadians do have a tax leak. I've been in the banking business for about 10 years and I can definitely say that the ones who are building wealth in Canada, they're not earning wildly more than you. They're just not on the default tax settings. There's a huge difference between being a taxpayer and a tax planner. It's not that the rules are unfair. I'll show you exactly how they restructure their income and legally plug the leak using the same accounts you probably have access to. So stick around and don't file for your taxes yet. Don't hit that submit button on TurboTax until you watch this. Now, do you remember last year when the capital gains tax was about to go up as high as about 66%? Well, thankfully that was cancelled. The headlines had exploded. Investors panicked, but then everyone was relaxed. Here's the truth. The real problem was never the 66%. It's the 42% that you're already paying. According to Fraser Institute, Canadians work until mid-June just to pay taxes. They called it the Tax Freedom Day. What that means is nearly half the year and nearly half your own income is not even yours. If your marginal tax rate or the highest tax bracket you're in is about 40%, saving $100 in tax is like earning $166 in salary. Now, I won't get into the math, but this is exactly how it works. If you have any questions, put them in the comments and I promise I'm going to answer all of them. The truth is you cannot just walk away from taxes in Canada. However, you can definitely structure your way out of them. And how do you do that? Well, point number one, the first home savers account. If you're eligible and don't have an FHSA, you're literally walking past thousands of tax-free dollars over the next few years. The first home savers account is a triple threat. Well, let me explain. The first home savers account works exactly like an RRSP and a TFSA at the same time. So imagine you earn $100,000, you put $8,000 to an FHSA, you get a deduction in your income. Your taxable income goes from $100,000 to $92,000. This contribution works exactly like an RRSP. Now the money in the FHSA could be invested in stocks, bonds, mutual funds, ETFs, and all of that growth is tax-free, like a tax-free savings account. And then when you have finally decided to buy your house and you've decided to take that money out, well, that withdrawal is also tax-free, just like a tax-free savings account. Name me one account in Canada that can do all of these three things at the same time. So again, put $8,000 in an FHSA. Let's say you earn $110,000 in Ontario. That's roughly a $2,700 refund. Well, the truth is it's not really a refund. It's just the taxes you overpaid to the Canada Revenue Agency that's coming back to you. But the question is, what if you never buy a house? Well, in that case, you can easily roll over your FHSA to your RRSP. No penalties, no lost room. I know it looks like magic, but it really is not. The only thing is that your FHSA room starts building only once the account is open. So open one this year. Even if you can contribute $50, $100, $200, you'll start accumulating your FHSA room for next year. Now, from my experience as a certified financial planner, this is one thing I've noticed. This is something most high earners miss. Not all income is taxed equally. You earn $1,000 in GIC interest, you're taxed on the entire $1,000 gain. But what if you earn the same $1,000 in capital gains through stocks, ETFs, mutual funds? You keep half of that growth tax-free. For example, if you are in a 43% tax bracket, $1,000 in interest, you keep about $570 in your pocket. You earn the same $1,000 in capital gains, you keep about $785. One little tweak on how it's taxed, and you're already 37% ahead. Different label, different structure. Now imagine how much this 37% could compound over the next 10-15 years. I've seen most Canadians always focus on what should we invest in, but the wealthy Canadians focus on what should we invest in and how will that investment be taxed. Which now brings me to the last strategy, the family strategy. I've seen so many clients and families with my own eyes save roughly $3,000 to $4,000 a year just by shifting which spouse claims the RRSP and who reports the taxable retirement income. Not because they found better stocks. The savings happened because they moved the tax bill from the higher income earning spouse to the lower income earning spouse. For example, if you earn $150,000 and your spouse earns $50,000, you're actually paying far more tax than a couple earning $100,000 each. You two can actually split your income and wealth through a spousal RRSP. This is how it works. Let's take an example of Kathy and Steve. Now, what Kathy does is that once her RRSP contribution room is confirmed on CRA's website, she takes that and contributes it into a spousal RRSP, which is in Steve's name. So Kathy is happy because she got a deduction at a high tax bracket because she's making $150,000. And what Steve is going to do is Steve is going to take the money out in retirement at a lower tax bracket. So taxes were saved here and paid here. And this difference is how you save thousands. It's a myth that people believe that the wealthy cheat the tax code. They don't. And they don't have to. They just know how to play this game by staying within the boundaries of the tax code. Okay, now let's make this real. Emma, she's 32 years old. She lives in Ontario. She earns about $110,000. Path A, the default Emma. She saves in a general taxable account. She ignores the FHSA, RRSP, TFSA, invests whatever is left. Path B, the planner Emma. She maxes her FHSA out, takes advantage of the registered retirement savings plan, RRSP, uses her TFSA or tax-free savings account strategically. 30 years down the road, default Emma ends up with $800,000. Planner Emma, $1.25 million. That $450,000 gap, that's not better stock picking. That's not even crypto. That's literally just turning off the tax leak. When 30 to 40% of your growth leaks every year, the magic of compounding, growth on growth on growth, it slows down over time. It's like running your wealth engine with the parking brake on. So now finally, to bring it all together, I'm going to leave you with something more practical than motivational. I want you to ask yourself these 4 questions tonight. Where does my next dollar of income come from? Point number 2, what type of income am I earning? Point number 3, am I actually taking advantage of all the registered accounts? And lastly, am I planning as a household or as an individual? Most Canadians keep working half the year for the tax man without ever questioning it. Well, if you've made it this far, you're not most Canadians anymore. So yeah, plug the tax leak and let me know what you think in the comments. I'm gonna make a separate video on TFSAs and RRSPs because it was too much information to fit in one video. Well, stick around. Thanks for watching. I'll be back soon.